All right, it's kind of fitting that we're here at the New York Stock Exchange. I mean, right below us, trading away there is the place, the epicenter of so much that went so wrong a year ago, and yet also kind of a place where some things are starting to look right. 1982, my first trip to New York, Wall Street Journal flies me up for an interview. An editor takes me out for a walk, and he says, I'm about to take you to the biggest gambling pit in the world, and it's ruled by fear and greed. And it was the New York Stock Exchange. And we've seen just how much fear can really rule down there. So are we finally coming out of it? Is it finally getting better? Well, we're going to hear from a guy, Barry Sternlicht, who's got somewhere around $3 billion riding on a big bet. So if you'll please join me in welcoming Barry Sternlicht. Okay, so you sit there, I sit here. Good. Now, I think it's somewhere around $3 billion, and then if you leverage that, you could get, what, 20, 30 to 1 leverage on that in these days? Or probably up to 12 billion, maybe 4 to 1. So I'm thinking you're feeling like we're okay and the economy's in good shape.
But not at all. First off, I thought you were saying $3 billion, you were referring to the Chorus acquisition we made, which was $2.7 billion, but you must be referring to the opportunity funds that we invest, which I think if we're lucky, I mean, that funds, we've invested so far this year in those funds, about $800 million, and they're only 25% leveraged. So you can't get leverage like you could before.
Right.
Certainly disciplines you, and it's harder to go broke if you have no leverage, which that's okay. But the world is not in great shape. It's especially the U.S. I do think that investing in real estate is a long-term game. And when I started in '91, we were buying from the RTC. Today the Chorus deal was bought from the FDIC, sort of added a letter, but it's still a government agency. The principles that I was so excited about in '91 when I started my firm are back in play 20 some odd years later.
And what three key principles would those be?
You're buying below replacement cost in the U.S., which is a big deal.
Good.
Thank you.
That's the number one thing? Or you got a couple more?
I got two more.
Okay.
You have positive leverage if you can get leverage at all. So if you buy it as even an 8 yield, then you can borrow at 6. You can get a 10 cash on cash, or 9.5, 10, which is compelling relative to the other asset classes, the fixed income, governments, even corporates, even junk bonds, and you just wait. And eventually, in a growth country like the United States, which we are still growing, people forget that unlike Western Europe, unlike Japan, we have demographic growth here. So eventually, if you're certainly a patient investor, growth will bail you out, unless you're investing in Detroit. So if you're in Detroit, you're probably not in great shape. But there are even in places like Albany, you can make money. So it's a great industry, the real estate industry, because it is the last great imperfect market. You're sitting over the epicenter of the perfect market, but real estate, it's not that hard. I mean, you have to keep common sense is really important, which most people seem to lose in the real estate cycles because they get access to both equity and debt capital. But at the end of the day, it is the most practical application of common sense probably in investing.
Well, especially if you're buying property instead of just pieces of paper, trading back and forth, which you do a little both though, don't you?
We do both. And they both take common sense. But I was once, when I was younger, I'm going to pretend I'm still young, I saw a sign at a Holiday Inn that said, it was one of those billboards, and it said, common sense is very uncommon. And I really believe that. I mean, it's amazing how, as we look at the Chorus assets, which are 102 construction projects all over the country, some of the stuff that was built is inexplicable. Like in the 40 miles from the nearest Indian reservation, and it's a high-rise, and all you see are tumbleweed. So you kind of wonder, did the loan officer ever come out to the site?
Field of dreams.
Those are the problems. Those are the problems when the basics of real estate are forgotten. They build 2-story retail. I learned that when I was 6 years old, that the second story of retail only rents on a pro forma for a banker, right? And
yeah. I'm impressed that at age 6 you knew the phrase pro forma.
I did.
All right, so we heard a couple reasons for why you're investing now and why it looks good. Tell us 2 or 3 key things that worry you about the economy and whether we'll have a second dip or whether we actually will
This
rebuild.
is not. I mean, people look at, then you see this is the second fastest recovery in history since the second largest dip and the second fastest recovery. I think fundamentally this is a different economy than it was any other recession that we've come out of.
Better or worse?
Well, different and worse, because it's being powered by government spending and not by private market spending. And it's, I used the analogy the other day of it's a lake, a thin lake, or a lake with a thin layer of ice on it. And some people came out and started to dance, and other people looked at them and said, they're not falling through the ice, and they came out. And it's a race between how fast the ice will get thick, how fast the economy will strengthen, and whether the weight of all these people now losing all their risk focus that they had the last 12 months are now just piling on top of the lake because everyone's got to be in the market.
Have we really forgotten
wants to
that
sit
quickly?
It looks that way. Yeah, I would say we're forgetting very fast.
In ice
corporate
fishing,
bonds, the real estate deals are trading faster and faster. The discipline of reading the documents, what these documents say in the fine print is, again, you're not having time to do. There's a tremendous global search for yield, and it's driving prices and yields, and it's supporting the market, probably, certainly in real estate, way ahead of the fundamentals.
So the low government rates allow me not to do any research and just to rely on Moody's.
Right.
Is that basically it?
That's not Moody's. I mean, you have, in 1991, 2, and 3, the REIT industry was really born when borrowers went public because they were going to go broke. Right? Everyone was recourse. Mr. Toll knows this with me, that the guys were recourse on debt. Instead of going, David Simon isn't here, I was with him yesterday, but I remember seeing his father, Mel, who should rest in peace, just passed away, in the office of my boss, crying, tears coming down his cheeks because our bonds were trading at like 9, but that was government treasuries, but cap rates were 6. So he was worth billions on paper. And then all of a sudden, malls were worth 10, and he had debt at 9, and he was broke. And how did he get out of being broke? He went public. And the market, short rates were so low that a yield of 5 or 6% on a mall looked pretty good to the public. And the retail guys stepped in and re-equitized the real estate industry. And that's the dirty little secret of how the real estate industry was born, the REIT industry. And it's happening again. I mean, we did a blind pool this summer. We raised just cash, but everywhere I go now, I hear about 43 different IPOs of anybody with any asset thinks they can go public. And probably at the moment, with the discipline or lack thereof in the public markets, you can do that. And we could probably take 4 companies public right now. I just don't know if we can handle it.
So I just want to make sure I got that right. What you just said is, what do you do when you go broke? You go public. I'm never going to look at an IPO in the same way.
Is there any press here? Seriously. Yes?
Yeah, there's select members.
I'm done talking.
Good, you go public. Okay, so when you take one of your next entities public, I think we're going to have to look at that. Good, liking that. And yet in crisis and in the fear lurks opportunity if you can get there and if you know what you're doing. And that's what you're betting on with yourself.
Yeah,
right?
I think that in all the debris, there's always great opportunity. And anytime the government gets involved in an industry, no matter what it is, there's things to do.
You can take government to the cleaners, can't you?
No, this time they're much smarter. They're our partner. So we're working for you. In chorus, if we do a good job, you make money.
Right.
Because you own 60% of the equity. The American taxpayer.
I'm just hoping they don't go after your salary once you start reaping really good profits here. We'll get to some of that government as partner stuff, but why don't we start with a global view and tell us around the world, either where you're investing or where you think the hottest spots are, where values fell the most, but economic growth is doing the best. I'm thinking, of course, China and Southeast Asia, but what else you got?
So in 2005, we invested $2.5 billion, and 80% of it was in Europe. It wasn't here. And then we opened offices in Mumbai, and we've had an office in Tokyo forever, and London. And we felt that there were much better opportunities outside the U.S. from 05 to 07. In fact, we went from $2 billion investing to like $600 million in 06 to $200 million in 07 globally. And we just stopped investing because prices went crazy, and I was having no fun. I thought risk reward. Today, we just bought our first building in London. We've bought in God knows how long. We got out about 2 years ago from our London holdings. And we just stepped in and bought a building in the city of London.
Right. Even in 05, why 80% Europe? Why not 80% Asia?
We have difficulty investing in Asia. I mean, we've been in and out of Japan. We've actually never lost money. I think we've done like 15 or 20 transactions there.
That's kind of shocking.
Yeah, it's shocking to me too. We just called the fall. It was the widest, and still is, the widest spread between yields on property and the cost of debt in the whole world is in Japan. Having said that, in a macro, nobody would ever invest in Japan on a macro basis because the people it's really a dying nation. And the industrialization, what you saw, I used to joke with the guys in the firm that Japan's blip and how it headed north the last couple of years was just the Japanese conglomerates building plants in China to put them out of business. So essentially, they were basically, as China becomes more of a manufacturing base, it's hard for Japan to compete with the lower cost of wage and labor. So China, we've been in and out of in two deals. One we're not totally out of, the other one we got out of, and we made some money. But I don't want to invest in China, actually.
Overheated.
I don't think they don't need our money. And I know we can get in, I just don't know when we get out. And since they're not telling us the rules of engagement, like for example, hotels in China and Shanghai are running 35% occupancy, and this mayor decides he wants to build another hotel. They want to build a whole new city somewhere. They don't actually tell you that when you're investing in downtown Shanghai, that they're going to move 14 industries 14 miles away and build another city. So from a supply-demand dynamic, it's not underwritable.
Right. All right, so it's Japan, China. What do you think of Russia? Because that population is declining rather than improving too.
All yours.
You won't touch Russia?
No, I've never been anywhere that I wanted to get out of faster in my life.
Okay. Europe, you're liking?
Europe we like, but Europe's stuck. The banks are stuck. The banks aren't selling the paper that they have. The entire British banking system's been nationalized. And the guys who have all the paper are just sitting on it. RBS, HBOS, Barclays, who's not part of the government ward. But when you're borrowing at zero, you can hold stuff for a long time.
Have they not written down the value enough of the MBS stuff?
To my knowledge, they've written almost nothing down in England.
The banks over there. Yeah. Whereas some of the banks here in the U.S. have taken huge hits, right? I mean, Goldman wrote off 50%, I think, of a lot of its holdings, didn't it?
But they got to borrow $30 billion at zero, too.
Yeah.
So I'd like them to spread a little love around to us. That's, I think, one of the things that you miss about the banks in the U.S. is that, and that's, I think, where the public outrage is justified, because it isn't, if you gave any of us money at zero, I'm sure we could make money. We could all buy treasuries, right, and make 3 points and make a lot of money, and to pay bonuses out of that pool.
Even I might be able to do that.
Even you.
And I'm terrible at this stuff.
And on the other hand, banks are not lending, and anything they say that they're lending is not true.
But isn't it a good thing when banks don't lend? Because doesn't it mean, they don't feel good enough to lend, and the guy applying for the money doesn't have a good enough credit record? I mean, maybe they're doing the right thing.
It has nothing to do with that. It's just they have, as they said to me, we can earn 20% buying securities. Why would I lend you money? And we have a situation now that's a multi-billion-dollar transactions. We're willing to put in over $1 billion of equity into the deal. Yeah. And the only banks we have talking to us are foreign.
This is a U.S. deal, right? Mm-hmm. Yeah. It's what was the name of it? Did you say?
I'm not telling you.
Okay.
But it's a good try.
All right. And yet Europe, as much as you worry about the banks haven't written off this stuff enough, Europe is outgrowing the U.S., much to my dismay.
Well, Europe's got a bigger problem. Europe has a currency issue now because the Chinese yuan being locked to our currency. As we drop in value against the euro, the yuan appreciates against the euro. I mean, depreciates also against the euro. So European exports, Germany's the driver of much of the growth of continental Europe. How's it going to compete where the dollar keeps weakening and the yuan keeps getting cheaper and cheaper? So it's something's going to give there. Europe's not really, it never took off and it never crashed as hard. It's hard. We own too many assets in Europe. It's very hard to lay people off. So you don't see these huge unemployments, but you never see the booming growth either. Right. So it's just a safety net. It's more of a spider web. It's harder to move it up and down.
In the boom of the 90s, Europe created vastly fewer jobs than the U.S. economy. We were far more robust. This time around, will the U.S. lead or will it lag behind in recovery?
It's pretty obvious we're going to lag behind.
Yeah.
To me, I mean, we don't have the infrastructure or the congressional and presidential leadership to create the jobs we need. If you rate $787 billion stimulus package and a couple $100 billion of it goes to tax cuts that didn't work under Bush, and we did them again under Obama, I mean, they should put $150 billion into alternative energy research, because that would create enormous jobs
40, I think they put
and
40.
have a dividend of trillions of dollars of defense spending we wouldn't have to bother with if we didn't have to rely on.
But government can't create jobs, though, at all, can it?
Sure it can.
Just creates a tax vampire bat attached to some body part.
If they gave a $50 billion grant to somebody who could cure the oil, our dependence on oil, I'm sure we'd create a lot of entrepreneurs who could do the Google of oil. Yeah, I mean, we are. Our greatest strength is our optimism, and we have no memory as a nation. Like Tiger Woods is going to be a hero in a year.
Is the no memory thing? Is the no memory thing a good thing or a bad
Britney
thing?
Spears was, right?
'Cause-
They love it. The Americans love this. We can't remember anything after it's off the post cover. We forget.
Right. Is that a good thing or a bad thing? On one hand,
It's
it's
a
helped us
strength.
forget some of the pain and the
It's
panic of
good.
a year ago.
It's very positive.
It's resilient, right?
Yes.
And yet, it's also disturbing.
No, I would say on the margin you'd like it this way. People who are optimistic about the future invest in companies and jobs and growth,
Right.
and the Japanese do not. They think in 5 years they're going to be worse off
Right.
than they are today.
See, that's my T-shirt saying that I want to start selling, is that capitalism is optimism monetized. I mean, that's what capitalism is. You bet because you really feel like something's going to go well. That's what you're doing right now.
That's a good saying.
Yeah, isn't it good?
Yeah,
I like that.
that's good.
Remember, you heard it here first. Don't steal it. I've already got the domain name. All right, so now why don't we get more specifically into some of the stuff you're doing and what it's like to be in bed with the Fed. I like it. It rhymes. It doesn't matter if it's accurate. I'm a journalist. I don't let the facts get in the way of a good story. So you've got roughly $1 billion fund that's investing in hotels. Is that right?
Yes,
Work inside. You got
that's correct.
I counted 2 or 3 major things you got going on. You got a $2 billion fund that's doing distressed.
No, you have a billion and a half dollar fund doing global real estate. You have a $1 billion fund that's investing in hotels. And then we have the $1 billion REIT that trades on the New York Stock Exchange that we took public August 10th. And that has about...
Because you're going broke. Gotcha. Okay, so we've got these 3 guys. And which ones have government deals going on, government as partner with their tendrils into your operation?
The Global Opportunity Fund participated in the purchase of Chorus Bank.
Right.
The assets of Chorus Bank. And that was the largest distressed property sale, I think, of the year.
Right.
And that bank, which was based in Chicago, had lent money all over the country to build condos, office buildings, and some multifamily properties.
Was it close to $500 million in loans outstanding?
No,
4.5
billion in loans.
$4 billion in loans.
4.5
There's a little
billion.
decimal point there.
Yeah.
Wow. Okay.
We paid about 2.7 billion for it.
So you got 4 point something billion. You paid 2.7. How much of that money was from government? You put up only what, 400
So the
million?
government financed the deal at 50% at 0% interest.
Liking that?
So it was $1.35 billion of equity, of which the government kept 60%.
Right.
So they pay us a management fee, and we split with them.
And you owe 40%?
Our group owns 40.
So you have 40% of any possible upside because you're willing to take on the risk, whereas you put up only, what's that percentage of the total money put in, like 5%?
20%.
Okay, 20 to earn 40, that's pretty good. Whereas the government put up 80 and it wants 60? Roughly? Is that-
Well, some of it's debt.
So you're ripping off the federal government, aren't you?
You know, it's not quite right.
Somewhere
They
around-
actually pay it. Look, this is a much better model than they did in the RTC days, because this way, you know, they're really renting these shops and having them work these deals out for them. So, and they did a market clearing price. I mean, there was an auction, and we tried to get some tweaks in the contract, and they said, nope, we're not going to do anything. They've been very, very tough.
Yeah.
You
I
know,
read somewhere that
honestly, the risk in dealing with the government, like in a deal like this, is probably not the FDIC. There is political risk anytime you deal with the government, particularly today. And since we bought a lot of 21 million square feet of residential projects, you know, I don't know, tens of thousands
Right.
of condominiums yet to be sold. I mean, sure, if a guy bought a unit in a building at 700 a foot and we're selling the unit now because we paid 100 a foot for it for 200 a foot, I'm sure that guy's going to send a letter to his congressman. and
Upset.
say, very upset.
Yeah.
He's taking me down.
Yeah, in fact, I was wondering about, you know, I believe when they started the PPIP, Make My Funk the PPIP, they said no backlash, no bonus capping, and yet they've said that before and then changed the rules. How worried are you about that?
I think you have to be concerned because I think the administration has definitely done some unprecedented things to the business community. I saw a little chart, which I guess was embarrassing. Somebody sent me yesterday that the Obama administration has the fewest number of business executives in places than any president in the history of the United States. It's like 8, and the average has been like 38. And so there's not a lot of experienced business people running around this administration. And I think for that reason, and I'm a Democrat, so I should say that I'm terrified, but I am a Democrat, and socially at least. And fiscally, I just think the government has to be careful. And the more they tinker with the rules for populist notions, the more difficult the recovery will be.
Right.
Because businesses will look elsewhere. Capital can move away people can pick up and go places. And,
Right, New Jersey knows that.
and there's a lot of attractive places to invest today, and they're not necessarily the U.S.
Right. What do you think of the PPIP? I could swear originally we thought $100 billion would be put up, they'd buy $1 trillion of bad assets. Now it's a shadow of its former self. And
they don't like these programs. So TALF, they don't really like TALF. They don't want to do single borrower TALF, which is the
Obama administration?
the Fed, the Treasury. Okay. They don't like these programs. The PPIP, I don't think they need it anymore. So they have 9 managers. One of them, I guess they just killed, TCW, so they have 8 managers. They don't like this program, and they don't think the market really needs it. It seems the markets, because of the search for yield, the markets have rallied so hard.
Worked it out themselves?
Fast. Yeah.
Do you think it's okay? Do you think we indeed don't need
at the moment they don't need it? Yes.
Do you not see toxic assets? We still have probably $1 trillion out there that we haven't fully written down. Is that not a big thing that we should be worried about looming over this entire thing?
Yes, but the banking system is bankrupt in the U.S. The regional banking system is playing hide the weenie, I guess. But I mean, it is the banks, if they mark their loans to market right now and had to clear them, there's very few banks, regional banks, that would be solvent.
Then why don't we need more PPIP?
Because PPIP doesn't address that issue. PPIP is really just buying securities in the market. It's buying residential securities that exist and were once AAA and are no longer AAA. You can buy those, but they had to be once AAA.
Right.
What they're trying to do is tighten the very bottom of the capital stack. I always look at it from the equity. So some people say that's the top of the stack, but I call it the bottom. They're just trying to tighten that, then they figured the rest of the, and that's true. I mean, if the AAAs tighten, then firms like ours with our Starwood Property Trust, REIT, can layer in more expensive capital and make the overall cost of financing palatable to a borrower. So it's a very valid strategy. But at the moment, as even the first TALF deal done, the Developers Diversified TALF that Goldman issued not a week and a half ago, only 20-something% of the people use TALF program. People, the insurance companies, everybody's just looking for yield.
So, but that's a good sign, though, that they didn't.
It's very healthy.
More people didn't use government.
That's a big deal. The markets are re-equitizing.
Right.
The markets are working. There's a liquidity bubble forming.
This thought, though, that we haven't written off enough of the toxic assets.
We haven't. There's no question.
Did the FASB accounting board make a mistake when it eased those mark-to-market rules and put less pressure on the banks? Was that it stayed hard?
I don't think that was a mistake. I think the recent announcement that if the appraised value is below the value of the loan and you don't have to take a write-down, that's a horrific mistake.
If the appraised value is below the value, you don't have to take. They recently made that ruling. I didn't know about that ruling.
Yeah, in the last 2 weeks.
Well, the numbers just.
You have to be in a conversation with the borrower. Yes, nobody noticed it, but it's a very dangerous precedent because you can't tell the banks from each other then. You can't tell who's a good bank, who's a bad bank.
Right.
And that's really a bad idea.
I always
the
hate
reason the reason the mark to market had to be suspended, and I thought was the right move, was because the markets got very thin and the marks were too difficult.
Yeah, and those weren't even realistic prices.
Right.
Give me a break.
Well, like for example, we bought bonds in Europe on a company in March at 28 cents, and now they're 93, and it's a real estate company.
Right.
So
did you sell them?
No, we're not selling them. We don't have nothing else to do with the money. So we're yield pigs ourselves. So
yeah.
We don't have. If we had something to do with the money, we'd sell them immediately. But that mark was a stupid mark. And if you'd taken a bank down with a mark like that, that would be dumb. But today, if I've got an appraisal on a property and it's $50 and the loan is $300, which it is on some of this stuff,
I think you should write off a little bit of that.
I would think you should write off a little bit of that. And we were hoping that the banks, there'd be a flood of paper. Now that the banks have recapitalized and the stocks are up, that they would actually take all that capital that's stuck in these assets and redeploy it to more productive uses, which is what we did in the 90s, the last time we did this, and it worked, and the bank stocks went up, and yet the banks have chosen not to sell their paper because they don't want us to get a 15 yield to maturity, and they said, we can do that because we're borrowing at 0, and they have no need, and that's why in the first quarter, I don't know what the statistics are now, the guy who runs B of A Real Estate said to me, we made $12 billion of loans in real estate. I said, wow, that's pretty impressive. I didn't see any of that. 11 billion of it was just rolling the existing loans that came due. And 1 billion of it was actually taking out other banks that had failed participations in deals that they were already in.
Taking them over.
So there was no net new credit creation for property.
Right, although at least those ones that were rolled over are now out of risk and don't pose a who knows whether they're going to go bad.
But the markets, the credit markets are healing. I think they may be overhealing.
Okay.
But not in the sense that there's a lot of real estate loans. Nobody wants to lend money to real estate because every bank, B of A and Wells Fargo, which have the 1 and 2 exposures to commercial real estate, I'm not aware that they're major sellers of loans. And I think they're hoping that values
There'll be a melt up.
Yeah, we melt up.
I mean,
And so far-
AIG
so far it's
recognized
working.
$5 billion
It's working.
in higher profit last quarter because it wrote up some of
On
the stuff that had written so far down.
On the other hand, a non-bank, GE, just wrote down their book, I think yesterday or 2 days ago. And they took a 30% markdown, and that was the first time they acknowledged that the $85 billion of property they have may not be
Let me tell you something.
worth par.
GE is selling NBC Universal and CNBC, so GE is dead to me. Let's not even talk about it. Let me ask you about paper versus property. When you go out and buy pieces of paper that are distressed debt, are you buying it because, you know what, I'm hoping the guy that issued this defaults on it, and I could take over his property and convert the piece of paper into property that I got for a dime on the dollar? Or are you buying the piece of paper to say, I'd like to flip this baby once it goes up? Which is more often though? Which
we
is smarter?
actually in the REIT we do loan to loan, which is the loan we think is a good value. And maybe the property's cash flow will rise, the loan to value will fall, and the credit quality of the paper will improve, so we'll get a gain on the paper. In our opportunity funds, we do loan to own, which is buy the loan and then hope to get the property at maturity. Most of the stuff, because LIBOR is zero, I mean almost everything is paying.
Yeah.
We see dozens of deals where the current yield is like 2, and the yield to maturity is like 52. Because it's not going to mature to the par. It's
Right.
not going to get paid off. So those are really tough deals to buy into a REIT that's supposed to pay a dividend because the current yield is so low. But we would do them in the opportunity fund if we felt that we could get the keys.
When you do it, buy a loan to own, almost in essence betting on the person's the company's default. Do you feel guilty at all? Do you feel any kind of moral compunction there?
Well, in chorus, I have 102 best new friends.
The people with the companies with the loans, yeah.
Everybody who borrowed has called us multiple times and wants to buy back their loans. So
Right.
I don't feel that. No, I don't feel guilty.
Okay.
I
Do I. I'm glad that, I mean, someone sold at a value and they sold for that reason and someone bought at a value. Interest rates. Obviously, the low interest rates around the entire world, the key kindling that you need here to get this warming fire started. But so at what point does that end? And at what point, when it goes to this level, I can't make money and I start to pull in my wings? What's going on?
The Fed is doing the same mistake Greenspan did. I mean,
They're waiting too long to raise. They should already raise. I said they should raise by June
If short
next
rates
year.
were a point, nothing would change, except some of the money that's seeking silly yields would probably go into savings. The reason people aren't saving right now, again in the U.S., is who wants to earn 10 basis points?
Right.
So 1 or 2% short rates would actually, I think, settle down the market. It would help us from. If this doesn't stop, you're going to see such massive inflation in 4 years, the first that I've seen since the 70s. And they're going to make it. They're not going to be able to turn it off. It's going to be like a snowball. So
can you make money at 2%? Right now, the rates are a quarter of a point down to zero. Right? Can you make money if it's up to 2%?
People would leave money in cash, and I'm talking about households. Corporations are sitting on the highest cash balances they've had in 50 years because they're terrified. But the consumer doesn't know what to do with the money, and saving and earning zero is not appealing to him. So he's taking bets and making bets in mutual funds and other stuff, and they're buying, looking for munis and other stuff, and they're not doing their credit analysis again. And we're doing it right over again. And we're doing exactly what we did wrong 5, 10 years ago.
So the Fed should start raising rates when?
Now.
Right away.
Right
We're
away.
waiting too long already.
Yeah. By the way, it would help the dollar. The dollar can't be in a free fall either. So it would balance the world. I don't want 4% short rates, but I think the short end of the curve must be raised now. If I was telling it now, like today.
Even though it's going to cost you money. You're not going to have as much upside leverage, or you're not going to...
It's healthier because the 10-year and the 30-year, which is really important for real estate, will not rise. If inflation goes nuts, the 5-year and the 10-year and home mortgages, which are 4.7 right now, will go to 7. If they raise rates and the economy sort of gently, the 1 or 2% money is not going to change the job creation profile.
So you don't have to worry about it killing the economy, and yet it might. Okay.
It would
and yet our economy is far more resilient now than in 1991 to come back because of tech.
No, our economy is not so resilient. Our economy is got a $1 trillion steroid rolling through its system, which is the government spending.
Yeah, but it looks so good. I mean,
yeah, it feels good, but it's not real. The patient's still on the operating table, and he's about to get off the table, and it's like giving your blood, right? They say, don't get up too fast. It's like, don't pull it. When they end the government's purchase of $1 trillion of agency mortgage backs in April, that program ends. Well, it'll be interesting to see what happens,
Right.
But I do think right now it looks all good, but it'll be interesting to see when they pull that out People don't understand
Okay.
what's going on in the credit markets.
And in
It's
the
not-
meantime, you're just
This
out
is not
there,
your mama's
You're spreading it
recovery.
around. You're making bets all over the place, aren't you? You're leveraging up like crazy, aren't you? You're
We
making
are
money while you
actually-
can.
It's fun again. It was not fun the last couple of years, and it's fun to invest in
Nice.
property.
You know what? I've been looking for a good upbeat note to end it on. It's fun again. Thank you very much for Barry Stern. There's going to be a 10-minute break, guys, before the next session on distressed real estate, and Mr. Sternlicht will be one of the members of that panel, so stick around. Thank you very much, Barry. Great job.